best traders refine their skills through practice and discipline. They also perform self-analysis to see what drives their trades and learn how to keep fear and greed out of the equation. These 11 Forex trading tips are tips that I've learned from the best traders in the game that are around right now. So stay tuned until the end, guys, and see what's in store. Before you set out on any journey, it's important to know exactly how you're going to get to that goal. But at the same time, it's important to have those goals in the first place. So number one, guys, defining your goal and your trading style. Is your trading method capable of getting you to that final end goal? Each trading style has a specific attitude and approach that you need to have when obviously executing. Any small personality mismatch will definitely lead to unforeseen losses and as well as stress, and we want to avoid the stress. Choosing a reputable broker is absolutely paramount. It's highly important that you guys spend the time to research your broker. You need to know your broker's policies and as well as how they go about their business. Make sure that the broker's platform is suitable for the type of trading that you want to do. For example, you use Fibonacci, but your trading platform doesn't offer the use of that Fibonacci tool. Is that such a thing that is conducive for your trading? Probably not. So you want to make sure that first of all, your broker allows you to trade the instruments that you want to trade, and as well as the platform that you are going to be using has the tools that enables you to function efficiently. Before you enter the market as a trader, you need to know exactly what methodology will govern the decisions that allow you to place trades on the specific things that you trade. You need to understand the information that you will need to make an appropriate decision that obviously falls in line with the methodology that you are trying to use. Some traders obviously choose to use things like fundamental analysis, and they look at interest rates and news and all of these other things, and other traders use tools such as technical analysis. Regardless of what methodology you choose, be consistent with that methodology. Understand what information you need to make that next trading decision. One more tip before we round it off: be sure that your methodology is adaptive. Be sure that whatever you are using can adapt and change as the market itself is adapting and changing. Many traders get confused when looking at different charts. Obviously, sometimes the information is conflicting, where an intraday time frame might give you a buy signal, but a much higher time frame might give you a sell signal. Now, what you want to do is obviously you want to be able, or you want to have the ability to synchronize what you are doing. Synchronizing the different time frames that you are looking at so that you find your specific entry points and as well as your specific exit points. So if you're taking a basic direction, maybe from the daily, make sure that your lower time frames, your entry time frames, align in that daily direction. Why? Because that will give you an area to enter the market, an entry point, and as well as when your time frames do align, you can obviously target that higher time frame level of structure for your exit points. Point being is that you've waited for your time frames to synchronize, you've waited for the market to align in your direction, you've found an entry point and as well as an exit point. Expectancy is a formula that you basically use to calculate what you can expect from your trading results. Simply enough, you're going to be going back in time and obviously measuring your losses versus all of your wins, and then you're going to see what is the difference between my losses and my wins. How can I derive a nice expected result, maybe coming to the conclusion of a percentage, but nonetheless, how can I conclude a nice expectation of what result I can expect from my system? Now, we know as traders, guys, one of the ways that we do this and find expectancy is through the process of backtesting. Now, we backtest to obviously see the results of our trading system, and then those results then become our expectancy. So we know that during live markets, when we are trading, we have an idea of what to expect from this current system that we are trading. Before you even start trading, it's so important that you already have determined the amount of risk that you are willing to take on this position. Now, also included in the amount of risk that you are willing to take is the amount of reward that you are expecting from taking that specific risk. Hence, we have our risk to reward ratio. Now, simply enough, risk to reward ratio is the amount we are planning to risk versus the amount that we are planning to make if this trade goes in our direction. Now, we know that it is important, if we have a system that has a low win rate, it's important that we have a system that includes big or high risk to reward ratios. And if we have a system that has a higher win rate, then we can conclude that obviously our system can still be profitable with a system that has a lower risk to reward ratio. Risk can be managed through the use of one simple tool, the stop loss order. What stop loss orders do is that they allow us traders to exit the market at a specific predetermined, and importance being on predetermined, that your stop loss areas should always be predetermined, guys. Predetermined stop loss areas. Predetermined stop loss areas. Guys, always have predetermined stop loss areas. Predetermined stop loss order allows us to exit the market at a specific point, which obviously we've derived through whether the use of technical analysis or fundamental analysis or what every other tool, but a specific area where we know that if price gets to this area, we want to be exiting this trade because the market is proving us wrong in some form, whether it's wrong in our analysis, wrong in time of entry, wrong on the directional bias. Regardless of what, we want to have a predetermined stop loss area and a stop loss order that obviously gets us out of the market at a predetermined specific point where we want to end and cap our maximum risk. Although it's important to obviously have a system that produces money, what's more important is for you to be able to manage your risk. Guys, never ever open a trade without that stop loss order. One of the most important things to remember that after you've deposited money into your brokerage account, that money is at risk. Every single cent of the money that you've deposited into your brokerage account is at risk. So obviously one thing is important, that you have ultimate focus. Know that your primary job in this market is to, number one, preserve your capital. How are you going to preserve your capital? By obviously taking small losses. We only need to cut one thing out of this equation: big losses. Once we cut big losses out of this equation of obviously trading, then guys, trading becomes a lot more smoother. The emotional journey becomes a lot more smoother. So guys, never forget that we are going to maintain focus on managing risk. How do we manage risk? We obviously take those small, well-managed losses. A positive feedback loop is created as a result of a well-executed trade according to your trading plan. When you execute that trade well according to your trading plan, it creates a positive feedback loop, which in turn obviously breeds that confidence. Success breeds success. So guys, you get that confidence from executing according to your trading plan. It's even better if that trade wins. If that trade is a loss, you've stuck to your plan and still there is that element of that positive feedback loop. So do you guys see how remaining disciplined gives you the gift of being disciplined? On the weekend when the markets are closed, a lot of us are probably maybe enjoying our time on our own. But guys, what I've noticed from these established traders is that the weekends are made to work. So guys, on the weekend, all of these traders are taking advantage of the fact that the markets are closed, that they don't have that added pressure of seeing the market moving, of having the market move, of being involved in the market, of having to split their focus in between analyzing, taking trades, and doing whatever. A lot of these traders are taking advantage of the quietness of the market, of that clear, sound mind during the weekends. And guys, we are doing weekend analysis. So preparing ourselves for the following week. Why? Because we absolutely have no idea what the market is going to do next week, but it's always best to be prepared. So during the weekend, you obviously do your weekend analysis, you analyze, you prepare yourself for the following trading week, so that regardless of what the market throws at you, you have a plan. You have a methodology that you are prepared to follow. You've also, during the weekend, reinforced your rules to yourself, reinforced your entry criteria to yourself, reinforced your methods of analysis to yourself, and all of those good things. So you are reinforcing and you are creating and re-establishing that same positive feedback loop. Keeping a printed record is the biggest and most important tip of all. Why? Because change begins with identifying the issue. If you've never had the opportunity to identify what is wrong within your processes, you won't have the opportunity to be able to change it. Because how do you change something that you don't know is broken? You will only know what's broken, guys, once you've taken your time to create a trading journal, to keep documents of your trading journal, whether it's you documenting your emotions, you documenting the trades that you take, you documenting your missed trades, you documenting your risk management. As long as you are keeping a documented record of your trading processes, you will be able to realize what is not functioning well in your process. And obviously, once you've seen what is not working well for you, you then begin to optimize your trading system and you begin to tweak things here and there. But how will you know to tweak? You will know to tweak once you've written down and once you are able to identify exactly where the cause of the problem is. The bottom line, guys, is that obviously having a plan and obviously doing self-analysis is important in the world of Forex. And if you have a plan to be successful, you need to take every single one of these tips to heart, because these tips are the foundational elements that will boost you and that will turn you into a profitable trader. Otherwise, guys, this is Tramayne, your FX Chasers mentor. Thanks so much, guys, for watching until the end of this video. If it's your first time on the channel, if you are a returner, thanks so much for being back on the channel. I will see you guys in the future videos. Have a great week, guys. Cheers.